Hi, this is CS Sai Akash. Let us continue our CA Intermediate FM revision series. And today we'll be discussing very important topic from exam point of view, from your CA final point of view, and also from the practical reality of financial management, that is capital budgeting. So FM is a function of three decisions: financing decision, investment decision, and dividend decision. Now investment decision, again there are two chapters: capital budgeting and working capital management. So capital budgeting is a very important topic from your exam point of view, as well as your CA final point of view, as well as your practical point of view. So with this background, let us understand how this chapter is being structured. So capital budgeting, investment decision, if you see, so basically there are three types of investment decisions that we need to study in this chapter. First one is accounting rate of return. Accounting rate of return, the alternate term for this is average rate of return. So accounting rate of return, it is also called as what? Average rate of return. Second one is payback period method, and the third one is DCF techniques. So basically we need to study all these three techniques. So if I go inside accounting rate of return, which is also called as average rate of return, I can calculate ARR. I can calculate ARR using two methods. First one is ARR based on original investment, and second one is ARR based on average investment. Coming to simple payback, so there are three methods: simple payback, discounted payback, and payback reciprocal. Coming to the DCF techniques, again there are three: NPV, net present value, and profitability index, that's called PI, then IRR, and the last one is MIRR, modified internal rate of return. Sir, what is the difference? Why do we have so many techniques to evaluate a particular investment proposal? Now if you see the accounting rate of return or the average rate of return, that is nothing but ARR. So they take decisions based on which amount? They take based on accounting profit. So the decision making here will happen taking what values as base? It will take decision based on your accounting profit. That is your PAT, profit after tax. Now if you come to the payback period, now the decisions here are taken based on CFT, that is cash flows after tax. And again, when you come to DCF methods, discounted cash flow methods, again as the name itself suggests, here we use CFT. So since the data on which these various methods take decisions are different, so there are multiple decisions, correct? Now, what do you mean by CFAT? Sir, what is the meaning of CFAT? Now, how do you calculate CFAT? You need to start with PBDT. What do you mean by PBDT? Profit before depreciation and tax. Profit before depreciation and tax is nothing but, if you remember your profitability statement, if you don't know profitability statement, go and check out my first revision lecture, then you'll understand. So from that profitability statement, I'll draw it up till PBDT. In that PBDT, I'll first reduce depreciation. After reducing depreciation, I'll reduce tax. So if you ask me why? Why? Because depreciation is an actual allowable expenditure under the Income Tax Act. So first I'll reduce depreciation, then I'll find out tax. Again, I'll add back depreciation. Why should I add back depreciation? You all know very well, because depreciation is a non-cash expense. So since depreciation is a non-cash expense, I'll again add it back, then I'll get CFAT. So basically, how do I calculate CFAT? CFAT calculation is very simple. PBDT minus depreciation minus tax, add back depreciation, you'll get CFAT. I repeat, PBDT minus depreciation minus tax, add back depreciation, you'll get CFAT. So basically, sir, why are we taking depreciation here? I am taking depreciation only to calculate tax impact, because more the depreciation, higher would be the tax benefit and lower would be the tax liability, correct? Now, if you see depreciation, I am reducing one time and again I am adding it back. So if in the question directly depreciation or the tax amount is given, what is the direct formula to calculate CFAT? It is PBDT minus tax. So if tax amount is directly given, then what is the formula? PBDT minus tax. It will give you CFAT, cash flows after tax. So this is all about CFAT. Now we'll move ahead with the first methods, that is accounting rate of return. It is also called as average rate of return, ARR. So as said, there are two techniques: ARR based on original investment, ARR based on average investment. The first one, ARR based on original investment. Again, it is a formula approach. Formula: ARR equal to average PAT. Average PAT. So you'll be given multiple projects. Number of years of data will be given. For example, 5 years data, 10 years data, 8 years data. So you need to calculate PAT and you need to take a simple average of that PAT. So what is the numerator? Average PAT divided by original investment. Original investment is your outflow, your particular outflow for a particular project. So you need to consider that. So what is the formula? ARR based on original investment is average PAT divided by original investment. Average PAT divided by original investment. Again, how it is denoted? ARR is always denoted in percentage. Coming to the second method based on average investment. Again, the name remains the same. It is accounting rate of return, also called as average rate of return. Nothing but ARR. So what is the formula for average rate of return? Numerator is exactly the same, average PAT, simple average of your profit after tax. Now, instead of original investment in the denominator, now you should take average investment. Sir, how do I calculate average investment? Simple. Original investment plus scrap value divided by 2. So how do you calculate average investment? It is original investment plus scrap value divided by 2. So this is how you calculate average investment. Again, ARR, to sum up, ARR based on original investment, ARR based on average investment. How to calculate ARR based on original investment? What is the formula? Average PAT divided by original investment. How do you calculate ARR based on average investment? Average PAT divided by average investment. Sir, how do you calculate average investment? It is investment value, that is original investment plus scrap value divided by 2. Now, what are the drawback? What are the observations of these methods? These methods are generally based on your accounting profit, that is your profit after tax. Again, it is easily manipulated. How? Sir, if I calculate depreciation based on SLM, the value will be different. If I calculate depreciation based on WDV, the value will be different. Correct? It is an accounting profit. If I put a provision entry, the profit will change. Correct? So PAT, profit after tax, are not a reliable source for decision making. Then it ignores cash flows. Ultimately, cash flow is important to run any business. If I don't have correct cash flows, then my liquidity as well as profitability both will be in trouble. So these methods, the ARR methods, will not consider cash flow. This is one more. Last one, what is the major drawback? It ignores time value of money. You know what is time value of money? Very basic concepts of FM. Yes. So ARR methods ignores time value of money. Coming to the next method, that is payback period. So in payback period, first one is simple payback. Understand the term payback. What do you mean by payback? Whatever amount of investment I have made in a particular project, after what amount of time will it come back to me? So if I put 10 lakhs, when will I get my 10 lakhs in return? Yes, that is called payback period. So in that first one, simple payback. How? What do you mean by payback? Payback is the time taken by investment to repay the entire investment money. So whatever is the cash outflow that you are making today, by after how many years you'll get that money back? That is called payback. In that simple payback, when the cash flows are uniform. When the cash flows are uniform. What do you mean by cash flows are uniform? Example, I invest 2 lakhs today. Every year 50,000, 50,000, 50,000, 50,000 will be my cash flows. Then within how many years will I get my money back? Obviously, if I'm investing 2 lakh and I'm getting 50,000 each year, then by the end of 4 years, I'll recover my entire investment. This is called payback period, simple payback. So what is the formula? Initial investment. In my example, it is 2 lakh divided by annual CFT, annual cash flows after tax. Sir, what if the cash flows are not uniform? What if the cash flows are not uniform? If the cash flows are not uniform, then you need to calculate cumulative CFT. So when you draw in the exam problem, PBDT minus depreciation minus tax, add back depreciation, CFT, then you need to prepare one more column for a cumulative CFT. You know what is cumulative? Year 1 means only year 1. Year 2 means year 1 CFT plus year 2's. Then cumulative for the third year will be above figure plus cumulative for the third year. Then cumulative for the fourth year will be above figure plus fourth year. So like that, you need to take the cumulative CFT, then you need to apply interpolation formula. You might have studied in maths interpolation formula. I'll explain interpolation very briefly as required for us. So how do you calculate payback period? I've taken an example. My payback is 2 lakhs. So at the end of 2 years, what is the amount of cash flow? Cumulative cash flow 1,58,000. After 3 years, it is 2,24,000. Now I know that my payback period, my 2 lakhs is somewhere in between 2 years and 3 years. So how do I estimate that? Using interpolation formula. So I'm taking 2 years as base. I'm starting 2 years plus. What is the difference here? The amount of difference I need. The amount of difference I need is between 2 lakh and 1,58,000. That is what I have taken here, divided by the total difference. What is the total difference between year 2 and 3? The total difference is 2,24,000 minus 1,58,000 into 365 days. So the difference I need divided by total difference. Initial years plus in the numerator, the difference I need divided by total difference. The difference I need divided by total difference into 365 days. So this is how you calculate payback period if the cash flows are not uniform. Again, what is the drawback of payback period? They are ignoring the time value of money. Time value of money concept is totally ignored. Coming to discounted payback. So what do you mean by discounted payback? Now, rather than taking cumulative cash flows, now I am discounting that cash flows. At which cost? That the opportunity cost given in the question. That is your cost of capital, also called as KE, also called as KO, also called as the minimum required rate of return, also called as WACC. So whatever terminology the examiner uses, I'll calculate. I'll discount those cash flows using that. For that, I'll do discounting. You know what is discounting? Getting something to the present value. Now I'll calculate the DCFT column. First, I'll calculate DCFT. How do I calculate? How do I discount those cash flows into discounting factor? Now I'll take a cumulative of that column. Then I'll apply interpolation formula. At the end I'll apply interpolation formula. Again, the logic will remain the same. I'm taking 3 years as big because after 3 years I'm able to recover my 2 lakhs. So I'll take 3 years as bliss plus the difference I need divided by total difference. The difference I need is 2 lakh minus 1 lakh 71,000 divided by total difference. What is the total difference between third and fourth year? It is 2 lakh 9,564 minus 171 825 into 365 days. So in 3 years 273 days it will be my payback period. Now what is the difference between simple payback and discounted payback? In case of simple payback, I am only recovering my original investment. In case of simple payback, I am only recovering my original investment. Whereas in case of discounted payback, I am recovering my initial investment along with the minimum required rate of return. That is your opportunity cost. That is your cost of capital. It means what? If I have discounted my cash flows at 10%, in case of discounted payback, I am not only recovering 2 lakhs, I am recovering 2 lakhs along with a return of 10%. So that is the interpretation. So what is the difference between simple payback and discounted payback is, in simple payback, I am only recovering my original investment of 2 lakhs. Whereas in case of discounted payback, I am recovering my 2 lakhs along with my opportunity cost of 10%. Whatever rate you had taken to discount those cash flows, I am recovering along with that amount. So that is the difference between simple payback and discounted payback. And because of this reason, discounted payback will always be higher than simple payback. Discounted payback is always higher than simple payback. And both the above concepts ignore post payback returns. Post payback returns means if I'm investing money somewhere, I'm not just investing to get that money back. I'm investing to earn some additional returns on that. Both of the above methods, the simple payback as well as discounted paybacks, are ignoring post payback returns. Correct? And payback always earlier the better. Payback is always earlier the better. So that is the concept of simple payback and discounted payback. Coming to payback reciprocal. What do you mean by payback reciprocal? See, for example, my initial investment is 2 lakh and my annual CFD is 50,000. How do you calculate payback reciprocal? What is the formula? Initial investment divided by annual CFD. Initial investment divided by annual CFD. So it is 4 years. So this is how you calculate your normal payback period. What is payback reciprocal? Payback reciprocal is a close appropriation of ROI generated by the project. Payback reciprocal is a close appropriation of ROI generated by the project. So in my case, what is the payback period? 4 years. Now if I do 1 by 4, the reciprocal of payback period, I'll get 25. So approximately this project is earning me 25% return. So that's the interpretation of payback reciprocal. So these are the 3 methods: simple payback, discounted payback. In simple payback, when the cash flows are uniform, formula. When the cash flows are not uniform, then the cumulative plus interpolation approach. Coming to discounted payback, again you need to discount the cash flows at the appropriate discount rate given in the question. Then again cumulative DCFT, then you need to apply interpolation formula. Yes, coming to very important approach, that is DCF. Exam point of view, and in reality 99% of the cases decision making happens on this. So what do you mean by discounted cash flow techniques? Sir, discounted cash flow technique means, first of all, we are considering cash flows. We are not taking decision based on accounting profits which are manipulated. We are taking decisions on actual cash flows. Point number 1. Point number 2, we are also considering time value of money because we are discounting them at appropriate discount rate. Now what are the principles on which these DCF techniques are based on? They are based on 2 techniques. One is earlier the better principle. Earlier means cash flows always earlier the better. Why? Because the time value of money, 1 rupee's value, if I receive it today, it will be 1 rupee only. If I receive it after 10 years, the value will be down. In other words, 1 rupee received today is more valuable than 1 rupee received after 10 years. Second principle, earlier the better. Second principle is higher the better. So DCF techniques follow which principle? They work on 2 principles. Earlier cash flows are better and higher cash flows are better. And it considers all the cash flows. Unlike the payback period method where only the initial investment was to be recovered. Here we are recovering initial investment along with the total returns generated by the project. In that very important and realistic one is what? NPV. What do you mean by NPV? Net present value. Sir, what is the formula to calculate NPV? NPV is nothing but present value of cash inflows minus present value of cash outflows. Understand why I am stressing on each word. How do you calculate NPV? NPV is present value. PV means present value of cash inflows minus present value of cash outflows. So what are the parameters I am considering here? When I say present value means I'm considering time value of money because I'm discounting all the cash flows to today's date. and I'm considering what cash, it means CFAT inflows. Yes, present value of cash inflows minus present value of cash outflows. So you should first ascertain cash flows. How do you ascertain cash flows? Again, PBDT minus depreciation minus tax, add back depreciation, will get CFAT. That CFAT you need to discount it at appropriate discount rate, then you will get DCFAT. So you need to take a total of that present value of total cash inflow minus present value of, again, present value of total cash outflow. You'll get NPV. Sir, how do you take decision based on NPV? If NPV is positive, you accept that particular proposal. If NPV is negative, you reject that particular project. If NPV is zero, it is an indifference point. Understood? How do you take decision based on NPV? NPV positive accept, NPV positive reject. Sorry, NPV negative reject. NPV zero means it is an indifference point. Very, very important from exam point of view. Understand what you mean by NPV. It takes decision based on two principles. One is cash flow. The second one is timing of those cash flows. So present value of cash inflow minus present value of cash outflows. Very much similar to that, we have something called profitability index. Again, NPV and PI will use the same set of data for decision making. That is nothing but present value of cash inflows and present value of cash outflows. The NPV will take the difference of that, and in PI, it is present value of cash outflow divided by present value of cash outflows. In PI, the formula is present value of cash inflows divided by present value of cash outflows. What is the interpretation? If PI is more than 1, you accept the proposal. If PI is less than 1, you reject the proposal. If PI is exactly equal to 1, it is an indifference point. Sir, if both are using the same data and the decision making is also the same, why there are two methods? It is because when the cash outflows are not same. If you are comparing two projects in which the investment amount or the cash outflows are not same, you will generally not take decision based on NPV, you will take decision based on PI. Why? PI will give you, PI is the present value of cash inflow per rupee of cash outflow. So what does PI give? PI gives the present value of cash inflow for every rupee of cash outflow. If PI, for example, 1.5, if I get PI as 1.5, what does 1.5 means? For every 1 rupee of my investment, I am getting 1.5 in return. So PI will give you in relative terms for every rupee what is the present value of cash inflow, whereas NPV will get a total figure whether NPV is positive or negative. So when the cash outflows for two projects are different, you take decision based on PI. Otherwise, generally, which is the most superior DCF techniques, it is always NPV. Understood? NPV and PI. We'll now move to very, very important, that is called internal rate of return, IRR. If you have watched my previous revision videos, there are certain topics. In case of cost of capital, I have left, even in decision dividend decision, I have left some topics because they want IRR base. Now IRR is also called as implicit cost, where in AS19, whatever in AS19 we have stated implicit cost, that is nothing but IRR. It is also called as YTM in the share markets language. It is also called YTM, and it is also called as CAGR. In mutual fund, it is called as CAGR, capital asset. Yes, CAGR. Now coming to what is IRR? Sir, exactly what do you mean by IRR? IRR is the exact rate of return earned by a project. Now understand why IRR is important. In NPV, you will say accept or reject. In PI, you will say more than one accept, less than one reject. But what is the exact rate of return I am generating, sir? If I am putting my money somewhere in a particular project, what is the exact return that I am generating? So to answer this question, you need to calculate IRR. So what does IRR say? IRR will give you the exact rate of return generated by a particular project. Now at IRR, understand this relationship very, very carefully. At IRR, present value of cash inflow is exactly equal to present value of cash outflow. What did I say? At IRR, present value of cash inflow is exactly equal to present value of cash outflow. And at IRR, NPV is always 0 and PI is 1. Understand the relationship between PI and NPV. If NPV is positive, PI will be more than 1. NPV negative, PI will be less than 1. If NPV is 0, PI will be exactly equal to 1, and this situation is exactly called IRR. So at IRR, present value of cash inflow is exactly equal to present value of cash outflow, and at IRR, NPV is 0 and PI is 1. So how do you calculate IRR? IRR is simple, by trial and error method. So how do you calculate IRR? By trial and error method. So how do you calculate IRR? So first what you will do, whatever is the discount rate given in the question, for that particular discount rate, you calculate discounted cash flows, and then you will ascertain what? Present value of cash inflow, then minus present value of cash outflow will give you NPV. Say for example, I am doing it for 10%. Now my NPV is positive. If my NPV is positive, what is the interpretation? It means that my particular project is earning more than 10%, correct? Now next what I will do, I'll assume some rate. For example, I'll take 15%. Now for 15%, again I will discount all the cash flows and then again present value of cash inflows minus present value of cash outflows, I'll get one more NPV. Now assume again at this percentage also NPV is positive. Again, if NPV is positive, what does it mean? It means my project is earning more than 15%. Now I'll again go to the next rate. Say for example, I'll take 18% now. Now for 18%, I'll discount all the cash flows. Then again, I'll do present value of cash inflow minus present value of cash outflow NPV. Now in this case, I get a negative NPV. Yes, I have to repeat this exercise till I get negative NPV. Now what did I understood, sir? By doing this trial and error method, it means my project is earning more than 15%, less than 18%. Now I got the this one range. It is more than 15, less than 18. Now I'll go and apply interpretation formula. What is the interpretation formula? Interpolation formula, sorry. Interpolation formula is IRR is nothing but start rate. In my example, 15% plus surplus. What do you mean by surplus? The NPV which you had got positive, the positive amount of NPV that you had got at 15% divided by surplus plus deficit. Surplus means again at 15% whatever was your positive NPV, that is your surplus. Deficit means at 18%, in my example, you had got negative NPV. So that negative NPV you need to take absolute figure. It means you should not put negative sign. It means you have to put positive sign only here. So surplus divided by surplus plus deficit into difference between start rate and end rate. What was the gap that I had taken? 15 and 18%. So 18 minus 15. Difference is 3% I need to take here. So how do you calculate IRR? First you will do trial and error. You'll start with the opportunity cost given in the question. If NPV is positive, take the next rate. NPV is negative, take the preceding rate. Generally NPV will be positive only. Then I'll go to the next rate. I'll take NPV. NPV is positive means again it means what? It is earning more than that. Again I'll go to the next rate. So the moment I get NPV negative, then I'll have a perfect range. It is more than 15, less than 18. Then I'll come and apply interpolation formula. Interpolation formula, start rate plus surplus divided by surplus plus deficit. Surplus means whatever was the NPV at 15% divided by surplus plus deficit. What do you mean by surplus here? Again NPV at 15%. Deficit means what? NPV at 18%. In my example, what is this? It is NPV at 18%. But rather than taking negative figure, you had got a negative figure there, but you should take it as a positive figure here. Very, very important. And difference between start rate and end rate is 18 minus 15. That is nothing but 3. Yes. This is how do you do IRR. So how do you calculate IRR? Very, very important. IRR equal to, first you need to do trial and error. Then you will understand the range above 15, less than 18. Then you need to come and put interpolation formula, start rate plus surplus divided by surplus plus deficit into difference between start rate and end rate. Understood? Very, very important. Immediately after revising IRR, please go and revise whatever we had kept pending. We had kept pending in cost of capital chapter, and we had also kept something pending in dividend chapter. Please go and do those because they are based on this concept. So cash flows will be there. You need to take all those cash flows. At what discount rate? At what discount rate my present value of cash outflow will exactly be equal to present value of cash inflow? Understood? So what is IRR? If I discount my cash flows, at what discount rate my present value of cash inflows will be exactly equal to present value of cash outflows? That is your IRR. Hope this is clear. Yes. Coming to very, very important some theory questions, NPV versus IRR. So there are two techniques. One is NPV, other one is IRR. Both have their own particular merits and demerits. Now, which is a superior method? Always remember, NPV is always superior to IRR. NPV is the most superior TCF techniques. Remember it at all times. NPV will prefer increasing cash flows. NPV will prefer always increasing cash flows. It means cash flows at a higher later amount of times are preferred during NPV. When I take decision based on IRR, IRR will always prefer higher cash flows in the beginning, which is correct also. Which is from this perspective, if you look at this perspective, IRR is only right. Why? Because it is always good to have higher cash flows at the inception. But NPV will prefer those cash flows which has higher cash flows at a later stage of the project. However, still why NPV is superior to IRR is because of the reinvestment assumption. Because of the reinvestment assumption, NPV will assume that whatever cash flows are generated by a particular project, when I reinvest those particular cash flows back in the business, they will again generate what? Cost of capital. So what is the assumption? Reinvestment assumption made by NPV. it assumes that whatever cash flows are generated, when I reinvest it back, again I will generate my cost of capital. That is my opportunity cost, which is a realistic approach. Whereas IRR will assume that whatever cash flows are generated by a project, when I reinvest back that in my business, they will again go and generate IRR. Understood? What is the reinvestment decision made by NPV? Reinvestment assumption made by NPV that whatever cash flows are reinvested, they again earn cost of capital. Whereas what is the reinvestment assumption made by IRR? IRR assumes that the reinvestment happens at IRR itself, which is a more realistic approach. Say, assume, see, it was a COVID period. In COVID period, the pharmaceutical company was in boom, correct? At that point of time, they might have had an IRR of say 40%. But once the COVID is gone, next year when I make the assumption, my company will not earn 40%. It may earn less than that. Correct? What is the more realistic assumption? Every year I'll generate the same IRR? No. Profit sometimes will be in an increasing or trend, sometimes they will be in a decreasing trend. So this reinvestment assumption, because of this reinvestment assumption made by IRR, NPV is always superior to IRR. Why? Because it makes realistic assumption, whereas IRR makes unrealistic assumption. This is one theory part which you need to understand. Coming to the last concept, that is modified internal rate of return. All the techniques in the entire chapter where cash flows or discounting is involved will discount all the cash flows to today's date and will take a decision. MIRR is the only technique. MIRR is the only technique wherein we'll not discount all the cash flows. We'll compound all the cash flows to a future date and then we'll take a decision. Understood? So how to calculate MIRR? First, you need to do present value of cash inflows. Step one is you need to first ascertain the present value of cash outflow. Next, you need to calculate the terminal value. Terminal value is nothing but the future value. So how do you calculate future value? Future value is nothing but present value into 1 plus I to the power n. Present value into 1 plus I to the power n. Here you need to solve for I. Here you need to solve for I. Whatever I you will get now, that is nothing but your MIRR, modified internal rate of return. This involves max. This amount of max you need to know. And whenever the cash flows are in the opposite direction, normally NPV and IRR will give you the same conclusion, same decision, whether accept or reject. But if the cash flows are moving in the opposite direction, then NPV will say something different, IRR will say something different. However, always NPV and MIRR will give you the same decision. NPV and MIRR will give a same decision. Why? What was the drawback of IRR? Drawback of IRR is that the cash flows will be reinvested at IRR itself, but MIRR will assume that cash flows will be again reinvested at cost of capital. So that is the drawback of IRR which has overcome in MIRR. Understood? At any given point of time, IRR is not relevant only because of this reinvestment assumption, and that is the reason whenever there is a conflict between NPV and IRR, NPV will prevail. But whenever you have to take decision between NPV and MIRR, both will give you the same decision. NPV and MIRR will both flow in the same direction. Understood? Again, these were the capital budgeting techniques. Coming to some variety of questions. One is capital rationing questions. What do you mean by capital rationing questions? You'll be given a particular amount of money for investment and you'll be given multiple projects. So in which project you need to put your money and which project you should not put your money, because you have limited resources, and how do you maximize return? Very common sense. If the projects are indivisible, what do you mean by indivisible? Say if there is a project and it needs a investment of say 5 lakhs. So if I go and invest, I should totally go and invest 5 lakhs, otherwise I should drop that project. That is called projects are indivisible. What do you mean by projects are divisible? It means that if the project needs 5 lakh and I have only 3 lakh, can I go and put my 3 lakhs in that? Yes. So projects are indivisible means either I have to make full investment or drop the project. Divisible means whatever is the money I have, I can go and put it in that. So when the projects are indivisible, first I will, by common sense, I will go and eliminate PI less than 1 or NPV negative. Why? If NPV is negative or PI is less than 1, what is the interpretation? Sir, whatever money I have put in, my basic investment, opportunity cost of capital, that also I am not earning. So I'll never select those projects with negative NPV or PI less than 1. Next, using common sense and trial and error, I'll maximize my NPV by trial and error. Then I'll see in remaining 4 projects wherever my NPV will be maximum. Wherever I'll have maximum NPV, I'll do that investment. Yes. Coming to projects are divisible. If the projects are divisible, first I will eliminate where PI is less than 1, then again my objective is maximizing NPV. By common sense, wherever PI is highest, I'll go and invest there. And whatever is the money I still left with, I'll go with the second highest NPV or the PI option. So by trial and error, you'll solve capital rationing questions. Coming to replacement decisions. Next variety of questions at CA intermediate is that replacement decisions. I currently have a machinery. Whether should I replace that machinery or not? So again, you need to find out three kinds of cash flows. First is you need to calculate the cash flow for your old assets. Next, you need to calculate your cash flow for the new assets, because whenever there is an existing asset, if I want to sell that, again there will be dismantling cost, their selling cost. Whenever I sell a particular asset, there will be capital gain or capital loss, tax saving on that particular asset, old asset. And if I'm buying a new asset, again there will be cash flows like I have to pay initial payment, then setup cost, then trial run cost, whatever, transportation and the recurring expenses, everything I need to consider. So I'll first find out all the cash flows related to old asset, related to new asset, then I'll calculate NPV. If NPV is positive, I'll go ahead with the replacement. If NPV is negative, I'll not go ahead with the replacement. Again, next variety of questions. Sir, in case of NPV questions, for NPV, I need both present value of cash inflow as well as present value of cash outflow. From exam perspective, there might be a scenario where both the information of inflow and outflow are not given. Then how will you take a decision? In those cases, if only cash inflows are given, you need to take them to the present value. So you list out all the cash inflows, you'll get them to the present value, and by common sense, cash inflow higher the better, lower the better. Obviously, higher the better. Sir, in the question, only cash outflows are given, inflows are not given. In that case, how will you take a decision? If only cash outflows are given, you will calculate everything to the present value, and outflow always lower the better. These are again next variety of questions. And one more variety of questions are, I have to take decision between two projects, but both the project slides are different. One project is for only 3 years, the other project is for 5 years. How will you take a decision then? Then in that case, you need to analyze the cash flows. How do you analyze the cash flows? Then you will take out the cash flows. It may be cash inflow, it may be cash outflow. I've taken the word cash flows based on the data given in the question. If it is related to inflow, present value of cash inflow. If it is only outflow, then outflow. Divided by AF. What do you mean by AF? Annuity factor. Annuity factor is nothing but the sum total of the PV factor or the FE factor. Yes. So I'll annualize. For 3 years, whatever was the total cash flow divided by annuity factor for 3 years. For 5 years, what was the cash flow divided by annuity factor for 5 years. Then I'll get annualized cash flow per annum. If it is an inflow question, higher the better. If it is an outflow related question, lower the better. Based on that, I'll take a decision. And what is the meaning of capital recovery factor? Capital recovery factor is nothing but the reciprocal of annuity factor. Capital recovery factor is a reciprocal of annuity factor. So in the question, if you want to calculate annualized cash flow, either you will divide the cash flow by annuity factor, or if capital recovery factor is given in the question, rather than dividing, what you will do, alternatively, you will do cash flow into capital recovery factor, because capital recovery factor is nothing but the reciprocal of annuity factor, either divided by annuity factor or multiplied by capital recovery factor. So this is all about capital budgeting. Very important chapter from exam point of view, and it is an open play area. Examiner can generate 100 questions. Sir, you go practice 100 questions, 101st question can be different. Sir, you go and practice 500 questions, the next question can be different. Why? Because it is an open field. I'll drop an entire story, blah 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 blah, chat GPT, and I'll give you a question. So you should practice maximum questions from this chapter so that you'll not miss out marks. And one more suggestion is that don't attempt capital budget questions in the first 1 hour or 2 hours of your examination. Do it in the last half an hour or 1 hour, because these are time consuming and lengthy questions. No doubt they are easy, but they are still time consuming and lengthy questions. Yes. So immediately after this, please open your question bank, solve each and every question from the chapter, so that along with the theory part that we discussed, the practical exam approach also will be covered along with me itself. Yes. Wishing you all the best for your exams. Have a great day.